Hey all, welcome to ShareTreck. This is Raj here. Guys, I hope you had a great weekend. I sure did. Today's video is going to be something in support of the video I did yesterday where I mentioned that rate cuts are going to be followed with share prices dropping. That was the conclusion that I made, and I asked you guys to let me know if I was right or wrong. Some of you gave me feedback, others didn't. I hope everybody does give a feedback so that we have a much better understanding. As a retail investor channel, we are building a community out here to exchange ideas and information so that we can be better at the markets. That said, today I have two experts. I have taken clips from CNBC. There are two experts whom I follow. At least one of them I follow a lot, which is Tom Lee, and both of them have made points which more or less aligns with what I mentioned in my video yesterday. So I'm going to show you those clips, and after each of those clips I'll explain the points that I picked up from there. Welcome back, friends. I would first like to cue up the video which has Tom Lee in it.
Down today's action with our first guest, FundStrat Global Advisors co-founder and CNBC contributor, Tom Lee. Tom, the small caps that I know you're watching closely had a good day, but I mean, is it September or is it not September, right? We had a rough start, and now some of that's in the rearview mirror.
Yeah, I mean, I think if viewers are sort of confused, I think that's what the next 8 weeks are going to be like into Election Day. I think it's a very challenging period because no one can have conviction until they really know who's in the White House. But there are some positive sort of supports coming into play, and next week is the Fed meeting. We know the Fed is going to make some cuts, and with the inflation data being supportive and the labor markets needing some support, I think it's going to give the markets some confidence. So I think we do kind of trade well into that meeting and maybe even the week or two after.
Does the market need a 50 basis point cut to stay within that 5,300 to 5,700 range that you think we're going to bounce around in?
You know, I think that a 25 or 50 has both hawkish or dovish implications.
Right.
So I think it's ultimately whether Fed Chair Powell comes across as this is the start of a cycle where they're confident that we're moving back towards neutral. And whatever number they make is actually quite dovish and positive. But if it seems like this is dragging along the FOMC members, and then there's even concerns about a hard landing, then I think the market can view anything they do as negative. I think it's going to come out positive, though. But
well, friends, in that clip, there were a few things that I noticed. The first thing is that Tom Lee is saying that people are going to be confused and there'll be volatility until the election is over and we know who is going to be in the White House. That's point number one. Point number two, he said that towards the rate cuts, the share prices will go up, but later on, maybe for a couple of weeks, and then it will go down. So that's the other thing that I picked up. And the third thing I picked up is that either 25 or 50 basis points, it's all going to depend on how Chairman Powell delivers the rate cut information and how the market receives it, whether it receives it as dovish or hawkish. And it's going to be very difficult to manage the expectations of so many stakeholders. It's not just what Chairman Powell says, it's also going to be the scatter map in which various Fed governors indicate their preference for rate cuts. So that will also give an idea to the general public of the deliberations that happened inside the Fed. So I personally think that it's a very fraught time in the market. So I'm going to stay on the sidelines and watch because historically, the interest rate cuts seem to have accompanied a severe drop in the share market for a prolonged period of time, contrary to what I believed before. The second clip kind of plays on this particular theme.
As Sarah says, a make-or-break week ahead as investors get ready for the Fed to cut rates potentially. Our next guest is, though, cautious for the rest of the year. Joining us here at Post 9 is Darrell Cronk, a Wells Fargo CIO for Wealth and Investment Management, target of 5,200. Darrell, good to have you.
Thanks, Carl.
Why the caution?
We just think we've front-end loaded a lot of the gains for this year. We do think the Fed has to get going. If you know, they should have went in July, in our opinion. They didn't, right? So now the question about 50 versus 25. Real rates are too high. In fact, if you look at real rates as inflation's come down, they're at the highest point in this Fed tightening cycle that they've been, which are grinding on the consumer, which is what you were talking about before. And the neutral rate, you can debate where our start is in the neutral rate. Let's say it's 3. If they come down 125 basis points this year, you're still at 4 to 4.25. You're still 100 to 125 basis points above the neutral rate. And there's just no reason for them to wait. So we think the delay, right, the risk here is they're transitory on both sides. They were transitory too late on inflation. Now they're going to be transitory and too late on the growth slowdown that's happening live as we speak.
So you think this is going to start to get reflected in earnings?
I do think it's going to start getting reflected in earnings. We already see Q3 numbers coming down to the lower end of their range, right? You've got 5 of the 11 GIC sectors sitting on the lower end of the range. Think about this. Just juxtapose these two things. Show me a time in history where you've gotten 10 plus Fed rate cuts and earnings have grown 15% the following year. Those two things just don't coincide. Something's going to have to give there one way or the other. Either you're going to get the earnings growth, of which you don't need 10 plus interest rate cuts, or you're not going to get the earnings growth and they're going to have to start cutting.
Isn't it your suspicion, though, that we don't get the 10, kind of like we didn't get the 6 in January for the year?
Yes, I think we've, the bond market has tried all the way along here to jawbone the Fed into getting what they want. The reality is, as we sit here this morning, though, the 3-month to 2-year, not the 2 to 10 year, but the 3-month to 2-year is 135 to 140 basis points inverted still, right? So the short side of the yield curve, which is more signal than noise, the long side's more noise than signal, is telling you the Fed's behind the curve right now.
Well, as you saw in that last clip, the question that keeps on haunting me is, show me a period of time when there were 10 rate cuts and the share market was going up. And as you saw in the last video I published yesterday or this morning, I had shown you the Fed rate cut cycle. I had mapped it exactly to QQQ. And we had seen that with every subsequent 25 or 50 basis point rate cuts, the share price QQQ was continuing to go down. QQQ represents the NASDAQ index. So it keeps on going down and it takes a little while after the rate cuts have stopped for the market to start picking up. And that period, I think, was somewhere close to 12 to 16 months, in my opinion. So I'm going to be very, very careful in the market in the next week. So my game plan basically is that I've already sold the profitable positions that I had. I'm just holding on to the long-term positions, which are heavily green right now. So I have to take a decision whether I want to sell them or not. And I still have the luxury of more time to see if those stocks are falling. If they start falling, they are in the consumer defensive area. If they start falling, then I will sell them off. Otherwise, I'm holding it. So that's what I am thinking is going to be the action plan for next week. So we have to just wait for the rate cut to drop in, and then we'll see what actually happens. It could be a learning situation for all of us. So those of our viewers who have more experience in this, please feel free to comment and let me know what you think about these conclusions, whether I got it right or wrong, and give me your own experience. It will always be helpful. With that, my friends, I'd like to bring this video to an end, and I'll catch up with you again in the next video. Bye for now.